Right now, US dollar to Japanese yen is hovering around the critical 157.10 level, as the Ministry of Finance stays vigilant against yen depreciation. Despite recent rate hikes from the Bank of Japan, there's a palpable skepticism in the market about a lasting trend reversal. Today, we're diving into why speculation about intervention remains at the 158 handle, the remarkable rise in Kioxia's market cap, and how the LDP is working to stabilize domestic JGB holdings. For weeks, the macro consensus has been clear: stay short on the yen to capitalize on the carry trade. Even after the Bank of Japan's shift away from negative rates and signals of further tightening, the yield gap with the US remains a powerful attractor for global capital. Traders have cautiously pushed US dollar to Japanese yen higher, but the shadow of past interventions at the 160 and 155 levels looms large. As we enter today, the 158 level is widely recognized among Tokyo traders as the intervention zone, where the Ministry of Finance may once again tap into its dollar reserves. Meanwhile, the Nikkei 225 is riding high on US semiconductor strength, creating a curious divergence. Japanese stocks are rallying while the currency struggles to find solid ground. It's a delicate balancing act that traders are navigating. In the latest New York session, US dollar to Japanese yen hit a wall at 157.10, facing heavy resistance as it approached the mid-157s. Traders noted significant selling pressure above 157.50, driven more by caution around potential interventions than by any fundamental weakness in the dollar. Even geopolitical tensions didn't provide the yen with a safe haven bid. On the equity front, a significant shift has taken place. Kioxia's market cap has soared to 25 trillion yen, surpassing Tokyo Electron and marking its status as Japan's largest electronics firm. This surge reflects a major rotation into artificial intelligence and semiconductor supply chains within the Nikkei. At the same time, the Liberal Democratic Party is pushing for an increase in retail JGB yields, aiming to keep government debt in domestic hands as foreign ownership nears 13%. This strategy may create a yield floor as the BOJ normalizes its balance sheet. Sentiment among Tokyo desks is tinged with a sense of too little, too late. A senior strategist from a major Japanese financial outlet pointed out that overseas investors are growing more speculative about intervention, viewing the BOJ's recent hikes as falling behind the inflation curve. The entrenched yen-bearish consensus persists despite these policy changes. An FX dealer from the prominent Tokyo firm, Min_FX, remarked that the upside for dollar-yen is heavily weighted, with traders hesitant to test the 158 handle ahead of potential Ministry of Finance action. Even in the face of global geopolitical chatter, the yen's response has been muted, indicating the market's singular focus on the MOF's next steps. Collectively, these insights paint a picture of a market that is short on yen yet cautious about the MOF's potential bold action. For traders focused on US dollar to Japanese yen, the 158 handle represents more than just a price level, it's a policy boundary. The key factor here is volatility. Should the MOF decide to intervene, we could witness a swift 5 to 6 yen drop in mere minutes, potentially obliterating leveraged carry positions. For Nikkei traders, the yen's current status is a double-edged sword. A weaker yen typically benefits exporters, but the current bad yen weakness is driving up input costs and pressuring the BOJ to act more swiftly, which could hurt valuations. The tech landscape is shifting too, with Kioxia's market cap overtake signaling a move away from viewing the Nikkei merely as a cheap yen play to one that is becoming more about global AI supply chain dynamics. If the BOJ finds itself cornered into a defensive rate hike to support the currency, the repercussions on JGB yields will cascade into bank stocks and real estate sectors. The narrative among the Japanese financial press, particularly the Nikkei, is focusing on a critical aspect often overlooked by Western desks: the domestic anchor of government debt. Recent reports about the LDP's intentions to raise yields for personal JGBs are noteworthy. This indicates the government's concern over the 12.8% foreign ownership of its debt. By making JGBs more appealing to Japanese retail investors, the Ministry of Finance aims to stabilize yield volatility during the BOJ's normalization phase. Additionally, local media emphasizes that while the BOJ is raising rates, the market's tendency to sell yen remains stubbornly persistent. They are framing the situation as not just a currency challenge but a test of the BOJ's credibility in managing inflation expectations. There's a growing sentiment that if the BOJ doesn't act more decisively, currency intervention could become inevitable. Current positioning indicates that leveraged funds are still significantly short the yen, though there's been a slight reduction in exposure near the 158 handle. Real money accounts are largely sitting on the sidelines, waiting for a clearer signal from Governor Kazuo Ueda. The prevailing mentality in US dollar to Japanese yen is sell on rallies once it crosses 157.50, fueled by fears of potential MOF dollar selling. Meanwhile, retail margin traders, affectionately known as Mrs. Watanabes, are clinging to their long US dollar to Japanese yen positions but are at risk of a sudden spike in volatility. In the JGB market, a proposal to ease early redemption rules for retail bonds could shift domestic flows, possibly flattening the curve if demand for the 10-year note increases. In summary, the market is poised, with significant liquidity waiting for the first signs of actual intervention or a policy shift. As we look ahead, four key areas deserve our attention. First, watch the 158.00 level in US dollar to Japanese yen. A breach here without a verbal warning from Finance Minister Shinichi Suzuki could signal speculators to push towards 160. Second, keep a close eye on Kioxia and Tokyo Electron. Their performance is a bellwether for tech investment flows into Japan. Third, monitor any statements from BOJ officials regarding the pace of normalization. Any hint of a July or October rate hike would bolster the yen. Finally, track the 10-year JGB yield. If it approaches the 1% or 1.1% mark, it will test the BOJ's resolve to cut bond purchases. Remember, U.S. inflation data remains a pivotal external factor. A strong reading could compel the MOF to act as the dollar rises despite Tokyo's efforts. Looking forward, we anticipate three main scenarios. In our baseline outlook, US dollar to Japanese yen remains confined within a 154 to 158 range. The MOF employs verbal intervention to limit the upside while the BOJ follows a gradual tightening trajectory. This environment supports equities, particularly driven by tech leadership. The strategy here is to engage in range trading on US dollar to Japanese yen and capitalize on tech dips. In a hawkish scenario, the MOF may execute a multi-trillion yen intervention following a breach of 158, or the BOJ could announce an emergency rate hike, rapidly pushing US dollar to Japanese yen toward 152. The strategy would shift to long yen and short Nikkei futures as a hedge. Conversely, in a dovish scenario, if US data surprises to the upside while the BOJ remains passive, speculators could drive US dollar to Japanese yen through 160, with the MOF struggling to take decisive action. This would favor long US dollar to Japanese yen toward 162, but with tight stops due to the high risk of intervention. In conclusion, here are the three key takeaways. First, the 158 level is a crucial threshold for the Ministry of Finance. Second, the leadership in Japanese tech is shifting, with Kioxia now at the forefront of the electronics market cap. Third, the LDP is actively working to strengthen domestic JGB holdings in anticipation of higher rates. Keep an eye on 157.10 for immediate support and 158 for the intervention trigger. For daily insights into the Tokyo macro landscape, be sure to subscribe to Tokyo Macro Daily and stay ahead of global trends.